Welcome to our lecture video. In this lecture, we are going to study project choice, capital constraints, and equivalent annual cost. In earlier capital budgeting discussions, the decision often sounds simple. Evaluate a project, estimate its cash flows, discount them properly, and decide whether it creates value. That approach works very well when a project is independent, meaning the firm can accept or reject it without affecting other decisions. But real business decisions are often more complicated. Managers may have several attractive projects, but only enough resources to choose some of them. They may face alternatives that compete with each other. They may need to compare equipment, systems, or contracts that perform similar functions but last for different lengths of time. So the question changes. It is no longer only, does this project create value? The better question becomes, which feasible choice creates the most value, given the constraints we actually face? That is the theme of today's lecture. We will look at mutually exclusive projects, capital rationing, profitability index, equivalent annual cost, and the role of managerial judgment. Let's start with mutually exclusive projects. Projects are mutually exclusive when accepting one project prevents the firm from accepting another. This can happen for many practical reasons. The projects may use the same site, the same machine, the same management team, the same brand position, or the same customer opportunity. A firm may also create mutual exclusivity by policy. For example, management may decide to use only one software platform, one supplier, one distribution strategy, or one major expansion plan. For independent projects, the decision rule is direct. Accept projects that create value and reject projects that destroy value. But for mutually exclusive projects, a positive NPV is not enough. Several alternatives may all create value, but the firm still has to choose among them. In that situation, the correct decision is not simply to choose any positive NPV project. The correct decision is to choose the feasible alternative with the highest positive NPV. That point is very important. The goal is not to find a project that is merely acceptable. The goal is to find the project that adds the most value. If all alternatives have negative NPV and the firm is not required to choose any of them, then rejecting all of them is usually the right decision. But if the firm must choose something for operational reasons, such as replacing required equipment, the problem may become a cost minimization decision rather than a value creation decision. Let's now talk about ranking conflicts. In capital budgeting, managers often see different decision tools pointing in different directions. One project may have the highest IRR, another may have the shortest payback period, another may have the highest NPV. When projects are mutually exclusive and the goal is value maximization, NPV is usually the preferred ranking method. Why? Because NPV measures value added in dollars. IRR measures a rate of return. A high percentage return can look attractive, but it may be earned on a small investment base. A lower percentage return on a larger investment may create more total value. This is where scale differences matter. A small project can look impressive when measured by rate of return, but still create less total value. A larger project can have a lower return percentage, yet create more value for owners. To handle this, managers can use incremental analysis. Instead of asking, which project has the higher IRR, we ask, does choosing the larger project instead of the smaller project create additional value? That is the right finance question. If the incremental cash flows from choosing the larger alternative produce positive incremental NPV, then the additional investment is worthwhile. If the incremental NPV is negative, then the smaller alternative is preferred. Incremental analysis helps us focus on the real trade-off, not percentages in isolation, but the value created by committing additional capital. Ranking conflicts can also come from timing differences. Some projects generate cash flows earlier. Other projects generate larger cash flows later. This matters because discounting gives less weight to cash flows that arrive further in the future. When the required return changes, the ranking of projects can also change. This is why NPV profiles are useful. An NPV profile shows how a project's NPV changes as the discount rate changes. It gives managers a visual way to see whether the ranking is stable or sensitive to the required return. When two projects have different timing patterns, their NPV profiles may cross. The discount rate where the two projects have the same NPV is called the crossover rate. The crossover rate is useful because it shows where the ranking changes. Below that rate, one project may have the higher NPV. Above that rate, the other project may have the higher NPV. But here is the key point. The crossover rate does not replace the firm's required return. The correct discount rate is still the rate that reflects the project's risk and the firm's opportunity cost of capital. So, when timing differences create a ranking conflict, managers should not simply ask which project receives cash sooner or later. They should ask which project has the higher NPV at the appropriate required return. That keeps the decision grounded in value creation. Let's now move to capital rationing. Capital rationing occurs when a firm cannot fund all positive NPV projects. This can happen for external reasons. A firm may face borrowing limits, lender restrictions, difficult capital market conditions, or covenant constraints. It can also happen for internal reasons. Management may impose a capital budget to preserve liquidity, reduce execution risk, control organizational complexity, or avoid stretching the firm too thin. Capital rationing changes the decision problem. If capital is not constrained, the firm should accept all independent projects with positive NPV. Each one adds value, so each one should be accepted. But if capital is constrained, the firm cannot simply accept everything that looks good. Now the firm must choose the combination of projects that creates the greatest total value within the available budget. That word, combination, is essential. Under capital rationing, the best decision may not be found by ranking projects one at a time. A project that looks attractive on its own may not fit well with the rest of the capital budget. Another project may be less attractive individually, but may help create a better overall portfolio. So capital rationing turns project selection into a portfolio problem. The firm must ask, which feasible set of projects creates the most total value, while respecting the capital limit and other real constraints? The profitability index can help with capital rationing, but it must be used carefully. The profitability index measures how much present value a project creates per dollar invested. In simple terms, it is a measure of capital efficiency. That makes it useful when capital is scarce. When projects are divisible, meaning the firm can accept portions of them, the profitability index can help management allocate limited funds to the investments that generate the most value per dollar of capital. This is especially helpful when the firm is trying to stretch a limited budget across many small projects. But the profitability index is not the same as total value. A project can be very efficient per dollar and still create less total value than a larger project. That distinction matters because owners ultimately care about total value created, not only efficiency ratios. So we should think of the profitability index as a helpful tool, not a complete decision role. It answers one important question: how efficiently does this project use scarce capital? But it does not always answer the bigger question: which set of projects creates the most total value? That is why managers must be careful. Under simple conditions, profitability index rankings can be useful. Under more realistic conditions, they are only part of the analysis. Finance tools guide judgment. They do not replace it. Let's look more closely at the limits of the profitability index. The first limitation is indivisibility. Many capital budgeting projects cannot be accepted in pieces. A firm usually cannot accept part of a factory, part of an aircraft, part of a major software system, or part of a strategic acquisition. The project must be accepted or rejected as a whole. When projects are indivisible, the best combination may not follow the profitability index ranking. The second limitation is mutual exclusivity. A small project may have a very high profitability index, but a larger mutually exclusive project may create more total value. In that case, the high index project is not automatically the better choice. The third limitation is project dependency. Some projects are valuable only if another project is accepted first. Others may become more valuable when combined with related investments. The fourth limitation is strategic sequencing. A project with modest immediate value may create learning, open future opportunities, or position the firm for later growth. The fifth limitation is multiple resource constraints. Money is not always the only scarce resource. Management attention, engineering capacity, regulatory approval, technology capability, and specialized talent may also limit what the firm can do. So the profitability index should be interpreted as a measure of capital efficiency. When constraints are complex, the real task is to choose the feasible project portfolio that maximizes value while respecting all binding constraints. Let's now turn to equivalent annual cost, often called EAC. Equivalent annual cost is used when a firm must compare cost alternatives that provide similar service but have different useful lives. This situation appears often in business. A firm may need to choose between machines, delivery vehicles, software systems, office equipment, maintenance contracts, or other operating assets. One alternative may cost less today, but require more maintenance or replacement sooner. Another may cost more today, but last longer or operate more efficiently. Looking only at the purchase price can be misleading. The cheaper asset today may not be cheaper over time. The basic idea of EAC is to convert the present value of each alternative's costs into an equivalent annual cost. Once costs are placed on an annual basis, alternatives with different useful lives become easier to compare. The decision rule is straightforward. Choose the alternative with the lower equivalent annual cost, as long as the alternatives provide equivalent service, equivalent quality, and equivalent risk. That last condition matters. EAC is not saying always choose the lowest annual cost, no matter what. It is saying if the alternatives truly provide the same required service, compare their annualized costs and choose the lower cost way to obtain that service. This method is especially helpful when the firm expects to need the service repeatedly over time. Equivalent annual cost is powerful, but like every finance tool, it depends on good assumptions. First, the alternatives should provide comparable service. If one machine has higher capacity, better reliability, lower downtime, or more flexibility, then the analysis should reflect those differences. Second, the alternatives should have comparable risk. If the cost uncertainty, operating reliability, or technological risk differs across alternatives, then simply comparing annualized costs may not be enough. Third, the service should be needed repeatedly. EAC is most useful when the firm expects to replace the asset or continue the service over time. If the decision is a one-time project with a clearly defined ending point, a direct present value comparison may be more appropriate. Fourth, managers should include all relevant costs. Purchase cost is only part of the story. Operating costs, maintenance, replacement frequency, downtime, training, disposal value, and implementation complexity may all affect the true economic cost. This is why a lower purchase price is not automatically better. An asset that is cheaper today may require more frequent replacement or higher annual operating costs. Another asset may cost more initially, but provide the same service at a lower annualized cost. EAC helps managers avoid being distracted by sticker price. It redirects attention to the cost of obtaining the required service over time. Let's bring everything together. Capital budgeting rules are powerful because they bring discipline to decision making, but they do not eliminate the need for managerial judgment. Managers should always ask whether the cash flow estimates are incremental and internally consistent. They should ask whether the same risk-adjusted discount rate is appropriate for all alternatives. They should ask whether the projects are truly mutually exclusive, or whether they could be staged, combined, delayed, or redesigned. They should also look beyond the capital budget. Are there constraints related to talent, capacity, technology, regulation, or management attention? Are there strategic options, learning benefits, or abandonment opportunities that are not fully captured in the base case analysis? Would the decision change if market demand, costs, or the cost of capital changed? The purpose of analysis is not to create false precision. The purpose of analysis is to make trade-offs clear. Good capital budgeting identifies which assumptions matter, which constraints bind, and which decision creates the greatest expected value after considering risk and feasibility. So remember the central lesson of this lecture. For mutually exclusive projects, choose the feasible alternative that creates the most value. Under capital rationing, choose the project portfolio that creates the greatest value within the constraints. For unequal life cost decisions, use equivalent annual cost when alternatives provide comparable service over time. Thank you for joining me today. I will see you in the next video.